Hello, welcome back. Uh, I'm Ali Reza Talebi. I help smart people like you make smarter financial decisions. Thank you for watching. High income creates opportunity, but it also creates tax complexity. For many educated professionals, taxes are one of the largest financial expenses they face over a lifetime. Doctors, engineers, attorneys, executives, and other high earners often focus on salary, bonuses, investment, retirement accounts. But one of the most important questions is not how much you earn actually, it's how much you keep, invest, and convert into long-term wealth after taxes. In this video, I will explain three advanced tax award planning strategies. They're called Backdoor Roth IRAs, Mega Backdoor Roth, and Tax Loss Harvesting. Just I want to remind you, these are not magic tricks. These are not for everyone as well. And they require careful coordination with your tax professionals, CPAs, and other professionals. But when they use properly, they can help high earners build tax diversification, improve after tax wealth, and make their financial plan more efficient. Before discussing those three strategies I mentioned earlier, we need to make an important distinction. Remember, tax mitigation is legal planning. Tax evasion is illegal. When we talk about tax award planning, it means that we are using the tax code properly. We are documenting transactions correctly. We are coordinating with our CPA and making sure that the financial decisions fit our broader plan. For high earners, tax planning should not be random or rushed. It should be integrated with retirement planning, investment strategy, cash flow, estate planning, charitable giving, and risk management. The best tax strategy is not always the one that reduces taxes this year. The best strategy is the one that supports the full financial plan over time. High earners often have more planning opportunities, but also more tax traps. What I mean by that? A professional earning a strong income may be phased out of certain deductions, unable to contribute directly to a Roth IRA, exposed to significant taxable investment gains, and subject to higher federal and state taxes. Let's go with state level. For California professionals, for example, state taxes can add even more pressure because California doesn't provide a special lower state capital gains rate the way that federal tax law actually does. This is why tax award planning matters. A financial decision that looks very good before taxes may look very different after taxes. The goal is not to let taxes control every decision we are making. The goal is to make better decisions by understanding the tax impact before taking action. A good tax strategy usually begins with tax diversification. What I mean by that? Think of your money in three different buckets. The first bucket is pre-tax money. This includes traditional 401k, 403b, and traditional IRA accounts. Contributions may reduce taxable income today, but withdrawals are generally taxable later. The second bucket is Roth money. This includes Roth IRAs and Roth 401ks. Contributions are made with after-tax dollars, but qualified withdrawals may be tax-free later. The third bucket is taxable money. This includes brokerage accounts, and these accounts are usually flexible, but dividends, interest, and realized gains may create tax obligations. High earners often focus heavily on pre-tax retirement contributions that can be valuable, especially during the high income years. However, building Roth and taxable assets can create flexibility later. Tax diversification gives you more control and freedom and flexibility in retirement, especially when managing withdrawals, tax brackets, and Medicare premiums and estate planning matter. The first strategy is called the Backdoor Roth IRA. Many high earners cannot contribute directly to a Roth IRA because their income is too high. So the Backdoor Roth is a workaround that may allow them to get money into a Roth IRA directly. So how it works? The basic process is this. First, you make a non-deductible contribution to a traditional IRA. Second, you convert that amount to a Roth IRA. And the third step, you actually report the transaction using the appropriate form, which is 8606. The main benefit here is that future qualified Roth IRA growth may be tax-free, but this strategy has an important trap, which is called the pro-rata rule. What I mean by that, if you already have pre-tax money in traditional IRAs or SEP IRAs or simple IRAs, the conversion may not be tax-free. The IRS looks at your total IRA balances when calculating the taxable portion. So the backdoor Roth strategy is very simple, specifically in theory. However, it must be implemented very carefully. So who should consider this strategy? The backdoor Roth may be very useful for high earners who are not eligible for direct Roth IRA contributions, but still they want Roth savings. It may work especially well when the person has little or no pre-tax IRA money. For example, a high-income physician or engineer who already maximizes a workplace retirement plan may use a backdoor Roth to build additional tax-free retirement assets. But if the person has a large traditional IRA, SEP IRA, or even simple IRA, the pro-rata rule may make the conversion partially taxable. This doesn't mean the strategy is impossible. It just means that it's gonna reduce its impact. So we need to run some analysis just to make sure it's relevant for that person. Sometimes a person may be able to roll pre-tax IRA money into a workplace 401k if the plan allows it to reduce the pro rata issue. But that should be reviewed carefully with the financial planner as well as CPA. Let's go with an example. A high-income professional is not eligible to contribute directly to a Roth IRA. They have no pre-tax IRA, SEP IRA, or simple IRA balance. They contribute $7,500 to a traditional IRA as a non-deductible contribution. Then they convert that amount to a Roth IRA. If done properly, and if there is little or no growth before conversion, the taxable amount may be minimal. The client must still file the Form 8606 to report the non-deductible contribution and track the basis. The practical benefit here is that the money is now in a Roth IRA, where future qualified growth may be tax-free in this case. The practical warning here is that the reporting matters. A good strategy done with poor reporting can create confusion and tax problems later. The second strategy is the mega backdoor Roth. This is more advanced than the regular backdoor Roth IRA. The mega backdoor Roth actually uses a workplace retirement plan, which is usually for a 1K, that allows after-tax employee contributions beyond regular pre-tax or Roth deferrals. Then those after-tax contributions are converted to Roth, either inside the plan through an in-plan Roth conversion or outside the plan through an in-service distribution to a Roth IRA. This can potentially allow high earners to move significantly more money into Roth accounts. But the key phrase here is if the plan allows it. Not all 401k plans allow after-tax contributions. Not all plans allow in-plan Roth conversions. Not all plans allow in-service distributions. So the first step is just read the plan to make sure it's eligible, and you should ask your benefits department as well. So just to better explain the concept, let's look at some numbers and an example. For 2026, the employee deferral limit for many 401k, 403b, governmental 457 plans, and the federal thrift savings plan is $24,500. But the broader defined contribution annual additions limit is much higher. It's around 72,000 for 2026. That broader limit includes employee contributions, employer contributions, and after-tax contributions. Catch-up contributions may allow eligible older workers to contribute more. Let's go with an example. Assume a professional is contributing $24,500 as their regular 401k contribution. And assume the employer also contributes another $10,000, which means the total contribution to the 401k is $34,500. If the plan allows after-tax contributions and Roth conversion, there may be room to contribute additional after-tax dollars up to the annual additions limit. Those after-tax contributions could then potentially be converted to Roth. This is why this strategy is called mega. It can create much larger Roth savings capacity than the regular backdoor Roth IRA. But the plan rules, cash flow, employer contributions, and compliance details matter. The mega backdoor Roth may be a good fit for high earners who already maximize their regular workplace retirement contributions and still have additional savings capacity. It can be especially appealing for executives, physicians, engineers, and professionals with strong cash flow who want more tax diversification. But remember, there are some major important watch outs here. First, the plan must allow the required features. Second, employer contributions count toward the annual additions limit. Third, the conversion should usually happen quickly to reduce the taxable earnings before conversions. Fourth, this strategy may be affected by plan testing rules, especially for highly compensated employees. Fifth, this strategy should not damage liquidity. A high earner should not put so much money into retirement accounts that they become cash flow fragile. Remember, tax efficiency is valuable, but flexibility is also very important. Let's talk about the third strategy, tax loss harvesting. Tax loss harvesting applies to taxable investment accounts, not retirement accounts. The basic idea is simple actually. If an investment is below its cost basis, you may sell it and realize the loss. That loss can be used to offset capital gains. If your losses exceed your gains, you may be able to deduct up to $3,000 against ordinary income in a year, with unused losses generally carried forward. This can be very useful for high earners with taxable brokerage accounts, especially during market declines. But remember, the tax loss harvesting should not be done just to create a tax loss. The investment strategy still matters. Usually the goal here is to harvest the loss while maintaining similar market exposure using a replacement investment that is not substantially identical. Why? Because if it's substantially identical, there might be issue with the wash sale rule. So it's going to become relevant and important. So we'll talk more about the wash sale rule later, but remember again, when you're replacing the investment, it shouldn't be substantially identical. Otherwise, the IRS is gonna remove that transaction from your accounts. Let's go with a simple example. Suppose a client sells appreciated company stock and realizes a $50,000 capital gain. In the same taxable account, another diversified investment is down $30,000 from the original cost. The client sells the losing investment, realizes the $30,000 loss, and reinvests that amount in an appropriate replacement to avoid the wash sale rule. So we have to be careful here. The $30,000 loss may offset part of that $50,000 gain. Now, the net taxable gain may be reduced to $20,000. The client still has market exposure, it still has the portfolio, but tax drag may be much lower. This is a good example of tax aware portfolio management. You are not trying to predict the market, you're using market volatility to improve the after tax efficiency. So, for high earners, this strategy should not be used randomly. They should fit into a broader tax aware planning framework. Start by asking these questions. What tax bracket am I in now? What tax bracket might I be in later? Do I need more pre-tax assets, Roth assets, or taxable assets? Do I have capital gains that need management? Do I have tax losses that can be harvested? And most importantly, has my CPA reviewed the tax reporting? The best tax strategies are coordinated. They should not be last minute decisions. What's the key takeaway point here? High income creates opportunity, but tax efficiency helps preserve that opportunity. Backdoor Roth IRAs may help higher earners build Roth assets when direct Roth IRA contributions are not available. Mega backdoor Roth may allow much larger Roth savings when the workplace plan actually allows that. Tax loss harvesting may reduce tax drag in taxable investment accounts. But none of these strategies should be used in isolation. Good tax planning should be coordinated with cash flow, investment strategy, retirement planning, estate planning, and CPA guidance. The goal is not to pay zero taxes. The goal is to make better decisions so more of your money supports your life, your family, your freedom, and your long-term goals. Thank you for watching. I'm Ali Reza Talibi, and I help smart people like you make smarter financial decisions. Have a wonderful day.